So as we go through, this is going to be quite a bit of information covered in a relatively short amount of time. So if you need any further assistance, you will have an opportunity to actually have a free consultation with us if you need one, either to review your documents, get you started, or to ask further questions. At Koppenbarger, if you attend an education event, it does get you a free consultation or review appointment. So please feel free to take advantage of that. And I'll mention that again at the very end. All right, so let's get started. It looks like I've got most of my people here, so we'll keep you guys on time. So good morning. My name is Victoria. I am one of the estate planning attorneys with the Koppenbarger Law Firm. I primarily work up in our Northern California offices. So if you are in or around Sacramento, San Jose, or Santa Cruz, odds are I will be meeting with you at some point or another. If I've already had a chance to meet with you, thank you for joining us today. It's good to have you. Now, I mentioned that I am one of our attorneys. So we are one of the largest estate planning firms in the state of California, and actually we're one of the largest in the entire country. The reason for that is multifold. One of the reasons is Lloyd, our founder, has built quite an incredible team of attorneys to make sure that our clients continue to be served to the greatest capacity that we are able. But the other reason is that we have more than just our estate planning department. We also have an estate administration department and a business and tax department. The estate administration department is there so that after you have lost a loved one, or for your loved ones who have lost you eventually, they have somewhere to turn where we can actually help them navigate, okay, from a legal standpoint, what needs to be done, what does the trust require, and of course, practically, what do I need to think about and what do I need to navigate now that someone has passed away. Our business and tax department is where, for many of you who are concerned about taxes or how to protect your business, you would turn to. Sunny Bourne is not only an attorney, she is also a CPA. And so she is able to help our clients mitigate or eliminate unnecessary taxes. But we could not do what we do without our absolutely incredible staff. As I mentioned, we are one of the largest estate planning firms, and a huge reason for that is our staff. They, again, allow us to communicate with clients on a much more frequent and regular basis than many other firms are able to. One of the things I hear from people who have started with another attorney and then come to us is one of their biggest complaints was they didn't hear from their attorney throughout the years. They don't even know if their attorneys are still practicing. Well, we are able to avoid that because of this incredible staff. We stay in pretty constant communication with our clients and make sure that your needs are met as often as they are needed. And then I also mentioned that I primarily work out of 3 of our offices. So we do have offices all over the state of California. But if one of these locations is not physically convenient for you, we can also do appointments via Zoom and the phone. Now, we are going to cover quite a bit of information, and again, it's in a relatively short amount of time. So there's a couple of things to note. One, I do recommend that you take notes as we go through, because a lot of times the notes that you take absolutely help in the appointment that you eventually set up with us. The other thing is, this is a lot of information, but we are recording it. And so this will be posted and sent out after it has been all cleaned up and we can get it out to you. We also have on May 11th, another tax webinar given by Sunny Bourne. That's going to dive into even more information on taxes. So if you need even more detail, you can of course watch that. And as I mentioned at the beginning, anytime you watch or attend an education event, you're entitled to a free consultation or review. And so that gives you an opportunity to come in and ask more case-by-case specific questions as is needed. So let's get started. So why is it so important to stay up to date with tax laws? Well, there's a couple of reasons. For one, if you stay up to date with tax laws, more often than not, we're able to save you money in the long run. Tax laws are one of those things that, while they don't change drastically very often, they do change. And so it's really important to make sure that you work with an attorney who can educate you on what those changes are so that you don't have to pay one more penny than is required in taxes. It also pays because it protects you and can absolutely defend your legacy. Again, we want to make sure that everything that you have worked hard to earn or build goes where you want it, not unnecessarily back to the government. And so when we're talking about legacy, this could be passing money down to children and future generations. This can be through charitable giving. This can be with a lasting business. There's many different ways that legacy comes out. But we want to make sure that what, again, you've worked hard for goes on for that legacy. And another huge piece is we never want clients to be hit with any unnecessary penalties. And so staying up to date on the tax laws allows you to avoid those penalties, especially in light of COVID and this year because of the significant weather we have had in California. The tax deadline has changed for the last couple of years. So we want to make sure that you know when those tax deadlines are to make sure that you don't miss one and end up being hit with penalties that, again, are unnecessary. There's also quite a few life changes that can trigger different need to be aware of tax laws, and within your estate plan, different planning needs that can arise. Some of the ones on this screen may absolutely apply to you and others may not. But if you see anything on this slide and you go, that actually might apply to me, I want to make sure I'm covered, or if I'm not already covered, that I get covered. A few of the ones that we'll talk about today in particular deal with minor children that are now adults. If you are married and somebody passes away, buying or selling a home, and then death or inheritance. One of the places I'm going to start right now, though, is with what is called the ERTC. The reason I am starting with this is it is a more urgent thing for anyone who ran a business during COVID years, specifically 2020 and 2021. If you were an active business who continued to pay your employees throughout COVID, you may be eligible for a fairly sizable tax credit. You have to meet one of these tests. So it's an or, if you'll notice. So you don't have to meet both of these, you just have to meet one. If your gross receipts decreased 50% from 2019 into 2020, or 20% into 2021, or you saw a 10% decrease in service hours and gross receipts caused by some sort of government order, you may be eligible for this tax credit. This is something that Sunny Boren is working actively with businesses on. And so if you are concerned or potentially an eligible person, absolutely come talk to us about this. When I say it's a sizable tax credit, I wasn't kidding. Depending on the number of employees, this really could benefit you even now, even after we're finally coming out of the COVID pandemic. But this is something that has a timeline on it. So call today to make sure you get an appointment with Sunny to see if this is something that applies to you. And if so, what kind of refund are you looking at? Now, the next piece we're going to talk about is charitable giving. This applies to pretty much everyone who has any kind of charitable intent. Not only does charitable giving really make people feel good, it is very studied and shows that generous behavior leads to increased happiness. So the happiness factor is there, but also charitable giving can lead to tax deductions and then more money in your pocket or more money in your beneficiaries' pockets. So when we're talking more money in your pocket, that ultimately means that you can give more to those that you choose rather than things having to go again back to the government. But it can also lead to more legacy for your beneficiaries. What that means is that if you have an estate that could be taxed, by leaving to charity, you can actually, in long terms, leave more to your beneficiaries because they are not having to pay a significant estate tax, which I'll talk more about in just a minute. So there's a couple of different ways that you can do this. One of the biggest is through charitable investments. There are certain investments that can offer you as the donor payments over years for the entirety of your life, while also offering tax breaks during those years. And then ultimately, when you pass away, the balance of that asset or investment will go to the charity of your choosing. Then there's other investments that essentially work in the opposite. They offer the charity payments over the years and can be returned to the donor at the end of the term that is established, while still having those tax breaks during and after your life. So charitable giving, again, can ensure that that charitable intention that you have is still met, while absolutely benefiting you from a tax standpoint. There's also a very important thing to be aware of, and those are called non-cash gifts, which have to do with asset-based giving. This is something of value that the IRS does not consider cash. And generally speaking, we're looking at stocks and bonds. And so there again are significant tax benefits with this. As far as what is a non-cash gift and how is it going to ultimately benefit you, this is where not only do we recommend working with an attorney who understands this, but also working with a CPA and a financial advisor who know how to collaborate and work together to ensure that whatever those investments are and that gifting looks like, that it's maximizing your tax benefits with nominal to minimal impact on you. Then for some of our other clients, they really want to ensure, again, with a legacy, that something is established, whether it's during their life or after they have passed away. And this is where we start looking at charitable remainder trusts. A charitable remainder trust is something where you can fund it and essentially say that either at the end of your life or even during your life, you want a charity to receive a certain asset. One of the ways to do this is by actually naming a testamentary charitable remainder trust as the beneficiary of your IRA. It's very simple to do this. You simply need a change of beneficiary form that is generally given to you through the institution that is currently managing your IRA, and we name your established testamentary charitable remainder trust. Now, a lot of times with change of beneficiary forms, they send you 16 plus pages, but you really only need 1 or 2. And so we are happy to work with you to not only establish your charitable trust, but also to make sure that the paperwork is properly filled out. Now, again, this specific type of trust is funded with the IRA after you have passed away. So it allows the beneficiary to still have a predictable income for life. It preserves your wealth. It protects the asset from creditors, and then ultimately the remaining balance of that is going to be gifted to the charity of your choosing. So going back to the legacy component, it allows, even after you are gone, for that legacy to continue in the form of charitable giving. Now, for other people, they don't want just charities included in gifting, they want specific individuals. We see this actually a lot of times with grandparents wanting to gift to grandchildren's education. Now, the gift tax is a very misunderstood tax. So gift taxes are going to apply to gifts or transfers made during your life. Now, this is where we look at what tax laws have shifted. It used to be that you could gift up to $15,000 per person per year without incurring any need to report it to the IRS. That has now been lifted up to $17,000. So that's an important thing to be aware of. But a lot of times people think that if they gift more than the $17,000, that they're then going to have to pay a tax. That is actually not the case. If, for example, you wanted to gift $20,000 to a grandchild this year, you would be able to do so without potentially paying any tax. You could gift up to the $17,000 guaranteed without tax, but then we're looking at what happens with that $3,000. Every single person has currently a $12.92 million exemption that they are entitled to for gifting purposes. What that means is this year, if you have not gifted more than $13 million, the $3,000 in excess of the $17,000 just gets deducted from that $12.92 million pool. So you have to tell the IRS that you gifted more than $17,000, but it doesn't mean you have to pay a tax on it. Unless you utilize your entire lifetime exemption, you will not be paying a gift tax on the gifts that are made. So again, this is something where keeping up with the current laws is extremely beneficial, especially for those who are wanting to gift more and potentially reduce the size of their estate. The other thing that has shifted and shifts relatively frequently is the federal estate tax. This is the tax that applies to transfers that are made after you have passed away. So this is where the federal government steps in and says, what was the size of your estate when you passed? And essentially, are we able to tax it? Well, for this year, the exemption is again all the way up at $12.92 million. But this is a fluctuating number. So it's really important to know if you have an estate that is around $5 million, we need to talk to you sooner rather than later. The reason is, again, this is a fluctuating number. And currently for the estate tax exemption, there is a sunset clause that in about 3 years, that 12.92 is going to be reduced to between 5.5 and $6 million. What that means in practical terms is that if you were to pass away and your estate was $3 million, you would not then be paying an estate tax. If, though, when that number is slashed, your estate is $7 million, then there is going to be a concern about your estate being taxed pretty heavily by the federal government. So this is extremely important to be aware of, and why it is so important to come in and talk with us every 3 to 5 years to make sure that we keep you apprised of what these changes are looking like, to make sure, again, you or your estate are not hit with an unnecessary tax. Now, for married couples, it's also important to note something called portability. Portability is essentially where you can elect to use your deceased spouse's unused portion of the estate tax. So to use more round numbers, if the estate tax when your spouse passed away was $5 million, but their portion of the estate was only $2 million, you could elect to utilize their unused $3 million and add it to your amount so that when you passed away, you had an additional $3 million of protection. But again, there's a sunset provision attached to that, and so it is important to stay up to date. The other issue with portability is you generally have about 2 years after the spouse has passed away to elect to take this. Now, for many people, 2 years seems like a very long time. But the issue that we often see is when a spouse is grieving, the last thing they want to do is come in and talk to an attorney about taxes. That's not normally what people want to do after losing a spouse. And so a lot of times when we are finally meeting with spouses to go through, okay, what's next, we have already passed that 2-year mark. So it is important to either come in and talk to us ahead of time to make sure that you are aware of what the options are, or we can actually set up what is called an A/B trust to essentially maximize to the greatest potential the estate tax benefits that as a married couple you are entitled to. An A/B trust is one of the tools in estate planning that, again, we're able to use to maximize your tax credits. Essentially, what an A/B trust says and does is that when one spouse has passed away, the trust effectively splits into 2 separate parts. You now will have a survivor's trust and a decedent's trust. So it's going to operate as 2 separate trusts. What that does is it removes 50% of the estate value when your spouse passed away from being added to your estate when you do. So again, what does that actually mean? If your estate was $5 million and the tax exemption is $5 million, your A/B trust, when the first of spouse passes away, would essentially eliminate $2.5 million from the survivor's portion. The survivor can still use that money during their lifetime. They can still use it for their health, for their benefit. They can manage it. But it means that when they pass away, they would only have their remaining, or what remains of their $2.5 million. And so this is a huge way to ensure that you are not, again, paying unnecessary taxes and that the wealth will ultimately stay in your family. This all ties back into legacy. We want to make sure that that money stays either in your family or goes wherever you would ultimately want it to go, not back to the government unnecessarily. Another thing, though, that you can do in your estate and in your estate planning is using what is called a generation skip trust, also known as a lifetime protective trust or even dynasty trust. There's multiple ways of calling it, so you may already have this. It just may be called something different than generation skip trust. A generation skip trust is specifically used to protect your children's inheritance and actually ultimately go down to your grandchildren and protect them. But it has more components than just that. If you establish these generation skip trusts, the inheritance that is left for your children will be protected from lawsuits, creditors, bankruptcy, the IRS, and a divorcing spouse. So essentially what that means is, as life happens, if unfortunate events occur, your children's inheritance cannot be taken away from them by outside predators. I'm going to specifically then focus on the IRS today. If, for example, your children, after they've inherited, end up owing back taxes, they've had some rough times, they weren't able to complete all the taxes that they needed to, and they owe the IRS in back taxes. The IRS cannot then touch their inheritance if it is put into one of these trusts. So it essentially acts as a safety net or savings account for your children to ensure, again, that they do not have that taken away from them, even in life's most unfortunate of events. It also, though, ensures that the wealth is going to stay in your family, not just for your children, but also for grandchildren. What these trusts say is that after the lifetimes of your children, anything within them that passes down to grandchildren will pass free of tax. So essentially what this means is, as the estate potentially changes, as the estate tax exemption changes, it's not going to matter for those assets that are in these protective trusts. The money could have grown millions of dollars during your children's lifetime. The estate tax exemption could be reduced to $1. It does not matter. That asset or those assets are going to pass down to your grandchildren without being hit with an estate or a gift tax. So this can be a huge way that you're able to benefit multiple generations and ensure that you know something is ultimately going to those grandkids, not to anything outside of what you would have wanted. If you don't have one of these trusts already in place, if you're not sure if you have them, or if you need more clarification on what does it effectively do for your family, come in and talk to us. But actually tying directly into those lifetime or generation skip trusts is the Secure Act. So this not only is going to apply to those of you who have those trusts in place already, but this is going to apply to anyone who has a 401k or an IRA and has beneficiaries on that account. So the Secure Act went into effect back in 2020 and then was adjusted in 2022. Basically, what this is dealing with, again, are your retirement plans. Now, we know retirement planning is a huge part of people's estates and often where they were saving to provide for future generations. Generally speaking, these IRAs and 401ks are going to be transferred by beneficiary designations. Typically, we see that you have named individuals on these accounts. Now, there's a couple of different issues with beneficiary designated accounts. One of the biggest is those assets transfer without protection if you have just named an individual. What that means is, tying back to those generation skipping trusts, if you had established those protective trusts, but have just named your children as individuals, that money that goes to them ultimately is not protected in their protective trusts. And so it's really important that if you have those established, or if you are planning to, that we talk to you about whether or not your child should be named as an individual, or if their trust in the future should actually be the one named. We want to make sure that, again, any amount of wealth that you have accumulated or any assets you have accumulated would be protected in those trusts, not subject to being taken away by outside predators. Now, with the Secure Act, there were a few good things to keep in mind that we just want to flag for you really quickly. For one, as far as when you are able to start taking your RMDs, it actually increased up to 72 in 2022. So that's really important to note, but also in 2023, it's increased to 73, and then in about 10 years, it will be increased to 75. You are also able to contribute a greater amount to your IRAs. So they raised it to $6,500, and if you are over 50, you can actually start to catch up on the years that you had not contributed the full amount. There's a lot to be said with IRAs and 401ks and how they can absolutely be beneficial to people. And so if you have more questions on this, or you're not sure if you have been doing it correctly, we can absolutely put you in touch, if you don't already have one, with one of the financial advisors that we trust and work with on a very regular basis. The downside, though, to the Secure Act is it says essentially outside of spouses and a few other exceptions, any beneficiary who inherits an IRA or 401k has to withdraw it within 10 years of the account holder's death. So what does this mean? Well, it unfortunately means there is, generally speaking, a much larger tax on the monies left because, again, rather than the beneficiary taking it over their lifetime, they have to take it within 10 years of you passing away. This is going to tie in a couple of different ways. If you already have protective lifetime trusts or those generation skip trusts in your documents, you need to make sure that the retirement language in your trust works with those protective trusts. If you don't know if you have that already, or if you have not been to see us in the last 2 to 4 years, then it's time to come in and discuss with us, is the language current? Because there is a risk if it is not current and a beneficiary inherits one of those accounts through their protective trusts, that they would be triggered with an immediate withdrawal of the funds rather than even having 10 years. So this, again, to avoid taxes, minimize taxes, eliminate taxes, is vital to make sure is up to date. The other tax that has really hit quite hard and is affecting a lot of beneficiaries at this point, and children in particular, is Proposition 19. So a lot of people still talk about Prop 13, Prop 58, they're still operating under old rules. But Proposition 19 eliminated those back in February of 2021. Now, most of the time we talk about Proposition 19 as a bad thing, and I will explain why in just a minute. But there was some good that came out of Prop 19, and this is frankly what they were pitching when the proposition went on the ballot. The good news is that if you are over the age of 55, severely disabled, the victim of a wildfire or other natural disaster, you can move into any higher cost home within California and retain your lower tax base up to 3 times during your life. So if you are planning to move, the good news is there's a chance you'd be able to take your lower property taxes to a new home, even if it's a higher cost. So that is a huge benefit. However, there's a huge restriction that was put on parent-to-child transfers for properties. If you own any secondary properties, so rental properties, businesses, land, anything outside of your primary residence, and it transfers after you pass away, those things are going to be reassessed under Proposition 19. That means that the property taxes are going to be raised to the current tax value as of your date of death. The other issue is for your primary residence, the only way for it to keep your property tax basis is if it transfers to a child who then considers it and claims it as their primary residence and lives in it within a year of you passing. If they miss the year mark, the property is going to be reassessed. And if they don't choose to live in it and claim it as their residence, it's going to be reassessed. So this has drastically reduced people's and children's ability to keep the homes that have potentially been in their family for years and decades. So it has been a really hard hit for most people. Again, what we have really found is it has drastically reduced intergenerational transfer benefits. But there is some good news. There are still planning options that are viable and available to help ensure that your properties keep their property tax basis. Now, for secondary property, so I'm going to really focus on rentals. If you already own the rental, there's at this point nothing that we are able to do outside of trying to get Proposition 19 overturned. But if you are planning to purchase a secondary property or a rental, before you do so, absolutely come and talk to us about an LLC. This is something that Sunny, again, on May 11th is going to address. If an LLC purchases a property, it then, when the LLC transfers to somebody new, means that the property that was purchased with it is not going to be reassessed. So, but this is, again, going forward, we cannot do it retroactively. So it's really vitally important that if you are going to purchase a property, come and talk to us first. Now, for your primary residence, there is language that we can put into your trust, especially if you have more than one child, that can maximize the ability for your child or children to keep your property taxes lower. The way that we do this is by using a right of first refusal. We essentially ask you, of your children, do you think any would want to own and live in your property? And if the answer is yes, who is the most likely? We then list out, in order of most likely, who would be able to essentially buy out their siblings. What that means is that when it comes time for distribution, let's say child A, we'll call her Susan. Susan can buy out her siblings so that they all still receive an equal inheritance, but she can own and have her inheritance as the house. If she then chooses to own that house and live in it and claims it within that year, she can keep your property taxes where they are. So again, all of the kids get an equal distribution, and that property tax does not have to be reassessed. Now, for other kids and families, nobody wants to own it, or at least they don't want to own and live in it. So then we start talking about, okay, would they rather keep it as a rental? The option there is generally just setting rental income at a level that would account for the new taxes, or a lot of times they start talking about wanting to sell it. When we talk to your children about selling property, they actually do have a fairly large advantage for property that transferred after you passed away from a capital gains tax standpoint. When you pass away, your property is going to be reappraised and given a new value. If your children choose to sell your home and they sell it for that new appraised value, they actually will not pay anything in capital gains taxes. So for property components, if they're not wanting to keep it or they cannot afford to keep it, the good news is that they still have pretty significant advantages with capital gains. But again, this is where I recommend come in and talk to us to answer and ask the questions that you have, because we want to make sure on a case-by-case basis, we're addressing what's going on. This is also where it ties back to our administration department. After somebody passes, it's really important to come in and at least do a consultation to make sure that your questions are answered. Because a lot of times after someone passes, there's a lot of things happening. And frankly, the last thing on most people's minds are taxes. But because of the certain deadlines and things that can impact your children and even a spouse, it's important to come and talk to us to make sure you're maximizing the advantages you have and reducing the potential liabilities. Now, really quickly, for those of you who have already established a Koppenbarger trust, it's really necessary and vital to note that if you have not seen us since 2018, now is absolutely the time to come in and talk to us. Due to tax changes and different government changes, there are significantly more protections that are available to you that are not going to be accounted for in your documents older than 2018. This can deal with long-term skilled nursing and protecting your assets from being absolutely depleted and wiped out due to long-term skilled nursing costs. If you have any special needs beneficiaries, there are significantly more protections that can be afforded to those beneficiaries than ever before. If you are concerned about IRAs and 401ks and making sure that that money is taxed to the lowest ability possible, come in and talk to us. We just covered Proposition 19 and making sure that, especially with your primary residence, we do whatever we can to keep those property taxes low. And if you have a higher net worth estate, so by this, I'm going to talk mostly about anyone who has over a $10 million estate, it's time to come and talk to us about trust protectors being named in your documents. A trust protector has significant power to make sure that as especially tax laws change, your trust can be changed to match those, even if you are not able to have the competency to do it yourself. So again, if you are in a concerning position where currently your estate is over 10 million, come and talk to us about a trust protector. But ultimately, everything that we do at Koppenbarger is designed to ensure that your legacy is protected. Lloyd started our firm with absolutely the foundational belief that every person has a legacy, great and small from a financial standpoint, and that that legacy deserves to be protected. Your estate plan is a huge step to ensuring that the financial legacy component is protected. But as I mentioned briefly, we also work with other qualified professionals. So if you need to have help connecting with a financial advisor, a CPA, an insurance agent, anyone who can help preserve your financial legacy and protect what you have built for anybody or anything that you want, come in and talk to us. Now, the other half, though, of what we do outside of the taxes, outside of the money, is the emotional side of things. The emotional legacy is something that, frankly, most attorneys do not address because there's no, honestly, monetary benefit to us doing so. But again, Lloyd started this knowing everyone has a legacy, and part of that legacy is an emotional one. And so this is a very big part of what we talk about for clients who have any interest or concern in addressing this. So if you don't understand how to leave an emotional legacy, or you need more tips and tricks on how to do so, a lot of times we hear that a grandparent comes in and says, man, my kids and grandkids really don't want anything, but how do I impart the value of the history of an item or the pictures that I really hope that they keep? We can help walk you through things that not only have we seen, experienced, and done, but also we can talk to you about what other clients have seen, experienced, and done. So any questions on this, please do not hesitate to come in and ask. Again, we believe your legacy matters. We are absolutely a family first firm. And so that legacy that we're helping you protect, we do it because we protect it for ourselves. And we believe the protections we are afforded that you should be afforded as well. So how can we help? Well, if you already have a plan in place, whether Koppenberger established it or not, we are happy to have you come in and review it to make sure that it is updated accordingly, to make sure, again, that that legacy is protected. It might be that we need to start establishing other more advanced trusts, like that charitable remainder trust that we talked about. Essentially, what we're looking at this point is how can we ensure that everything you want protected is going to be protected. Now, why should you use a qualified attorney, CPA, and financial advisor? And I use the word qualified very, very specifically. You want to ensure that you work with people who understand what we do. There are CPAs and financial advisors out there who, frankly, do not want to work with attorneys. They don't think that they need to work with an attorney. The risk of that is often there are tips, tricks, and things that the attorney is able to do that the CPA or financial advisor does not know about unless they are willing to work with an attorney. And so this is a huge benefit to working with qualified CPAs and other professionals who understand what we do and are also willing to ask questions if they don't. Now, as I mentioned, we are a very large firm and we have been around for over 40 years. The other thing is that our attorneys consistently are educating themselves and obtaining advanced degrees to ensure that rather than you having to go and find the information and then figure out how it applies and come to meet with us, we go and research the information, see how it applies, and then come to you to make sure that we've educated you so that you can start seeing how this might affect you and your family. Now, after this webinar, you are going to receive an automated phone call asking if you are interested in setting up an appointment. To do so, just listen to that message and then hit pound when it prompts you. Again, because you sat and watched this webinar today, you are entitled to a free consultation or review, even if it's just to ask some questions and you don't need any changes. So please take advantage of that time. We are absolutely here to help. If you want to reach out to us now, we will be standing by for a couple of minutes. You can also email us at the info@koppenberger.com, visit our website, or give us a call at any time. All right, I don't think I see any questions currently, but again, I'm going to hang out for a little bit in case there are some questions. Thank you guys for joining us today, and we look forward to working with you. All right, it looks like people are starting to log off, so I am going to end the webinar. Again, thank you all for joining us. We look forward to working with you and answer any questions that you may have. Have a great rest of your day, and pretty soon, have a great weekend.